Well, welcome to the second segment of January's 2021 Public Finance Conversation with Betsy Kiehn. And as a result of our last conversation, we have two questions today instead of just one. But what we want to focus on as our first question is, Betsy and I planned on recording this on January 13th, 2021. When I had my notes set up for that meeting, I had the 10-year treasury at 1.15. It didn't stay there all day, but before that call, it was at 1.15. When I was updating my notes for the conversation on January 14th, 2021, I had the 10-year treasury at 1.10. And also in my notes, in late December, the 10-year treasury is at 0.85 to 0.9. So looking at that suggests a lot of volatility. Betsy, what are you seeing for the year 2021 on the 10-year treasury?
Sure. So certainly, you know, as we talked previously, 2020 was a volatile year. 2021 starting out that way as you look at treasury market yields, right? The expectation that we're going to see additional spending out of DC and the path to economic recovery isn't quite clear is the reason I think we're seeing rates bounce around as you just described. I think there's the municipal market, however, right? The municipal market usually takes its cues from the treasury market with very few exceptions. And I would say this is one of these very few exceptions. The municipal market has held in quite well here as we've started out 2021. I think following on the momentum and success of 2020, certainly, but I think more important than that, as we look at the range in which rates are and potentially are headed, you know, 10-year treasury yields, here, Bloomberg consensus for the end of 2021 is that 10-year treasury yields will be at a 121. Only 4 out of those 61 economists surveyed think that rates are going to be higher than 1.5% at the end of 2021. And 11 out of the 61 thinks rates are going to be lower than 1%. So while we've certainly seen a pretty significant move again in a short period of time, the expectation that we're range bound within this 20-ish basis point window is something to be, or at least maybe I'm optimistic about.
Great. Well, thank you. And certainly be interesting to see how that unfolds, because it certainly has had a lot of movement over the last year, I'd say.
Okay.
Well, when you and I both started in public finance, rates were higher. If you would have told either one of us, or if anyone would have told either one of us that the 30-year would regularly be under 4%, I think we both would have been surprised.
Right.
When I was doing pro formas for land secured projects, I oftentimes would assume an interest rate of about 7.5%. And sometimes the developer would negotiate me down to 7.25. Now, in those same pro formas, we're regularly using 4.5 to 5.5. What is driving the decline in credit spread or the narrowing of credit spread, and what do you see going forward?
Sure. I remember things pretty similarly, right? As credit was challenging, we were doing deals in the early stages, and 5 and 6% yields were pretty normal. Here we are today, and I can count probably on both hands the amount of deals within the high yield space in California that have yields north of 4%. And certainly it ebbs and flows, and credit is important overall, but I would say real resistance is at yields less than 3% in 30 years, which is remarkable for a high yield market. Nationally, certainly it's a little bit of a different story. But I think the same holds true with the exception of just a couple of sectors, those most recently most impacted by COVID. But overall, I would say it is, the municipal market overall over previous years that has seen credits improving in yields and credit spreads moving tighter. So what we have is an investor base that is going out the yield curve and willing to take on a little bit more risk at the means at arriving at incremental yield in an environment where it doesn't naturally exist. And so while I think credit overall is going to become more important in 2021, and we saw that really in 2020 as well, as the high yield market was coming back online, there was certainly some hesitation. So momentum, projects underway, and diversity in their scope and size was certainly important. But I think here it's really that dynamic of credit spreads overall and arriving at slightly higher yields.
Well, it certainly has been interesting and how tight those credit spreads have gotten. What do you think are the driving factors? Is it Fed policy? Is it that increasing the demand from a international audience versus, maybe a small segment that knows about municipal bonds in the United States? What is it that drives that, or driving that?
I think it's a little bit of both, right? We have yields around the world that are pretty anemic in a sense, and I think we're seeing foreign investors trying to take advantage of that, if you will. And so we don't often see those foreign investors directly participating in deals, but I would say their money's being aggregated on behalf of the traditional buyers in the overall market. Monetary policy continues to be pretty accommodative, lower for longer, no lift off till 2023. And then I think, again, the market technicals are quite strong, right? We've got 26 out of the last 33 weeks money coming into the high yield space. And, I think in particular for California, right, the structure, the Mello-Roos structure is one that has been tested in a market downturn, and it has performed well. So I think certainly, again, back to the momentum of the sector being pretty positive to how investors are putting money to work is helpful overall.
Great. Well, thank you, Betsy, for taking part in the second phase or second question of January 2021 Public Finance Conversation.